Hi, and welcome to another presentation from your business tutor, learning your way, anytime, anywhere. Money makes the world go round is a commonly used expression which stresses the importance of money in all our lives. However, from a business perspective, it means even more because money is the fuel that drives a business forward. This is why this presentation on sources of finance is so important. So what are we going to learn in this presentation? Well, first of all, we're going to find out about sources of finance suitable for large organisations. We're then going to investigate the advantages and disadvantages of each source of finance. And then we're going to explore the factors that influence the source of finance used. Okay, let's get started by asking, what is debt factoring? This is an external source of finance that allows a business to raise money by selling the value of its customers' accounts to a factoring business. How it works is that many organisations sell on credit to their customers, meaning although they have sold products, they will not receive any money until around 30 or 90 days later when the customers actually pay. As you can imagine, this can cause problems for a business as it has to pay its suppliers but won't have any money from its customers to do so. As such, to get round this problem, a business can sell the value of the money due from its credit customers' accounts to a factoring business at a slight discount for immediate cash. For example, if a business were due £1 million from customers, the factoring company may give the business a discounted amount of, say, £900,000 immediately for those accounts. Over the next 30 to 90 days, the factoring company will then collect the £1 million due from credit customers. Once all the money has been received, the factoring company will then pay the remaining £100,000 they are due to the business, less any bad debts, customers who have not paid, plus its fee. As can be seen, a big advantage of debt factoring is that a business does not need to wait for its customers to pay, meaning it can pay its suppliers immediately from the cash it receives from the debt factoring business. Further still, as the debt factoring business collects the money due from customers, it means an organisation can save on administration costs of collecting payments itself. However, and as was shown in the example, there is a fee for using a debt factoring business, and it can be rather expensive. Moreover, the risk of bad debts, in other words, customers not paying, still lies with the business itself, in that if customers don't pay, the business will receive less money from the factoring business. Further still, the money provided by the debt factoring business, as the example showed, will only be a percentage of the full value of the credit customers' accounts. Okay, let's now turn our attention to a rather modern approach to raising finance that has evolved out of the internet, and that is crowdfunding. All the finance options we have looked at so far have come from a single source. Crowdfunding, however, turns this concept on its head and involves asking a large number of people for a small amount of money each so that a substantial amount can be raised. How this works is an organisation will place details of the project they want funded on a crowdfunding website, hoping that people will be interested and will want to invest. Usually, business crowdfunding happens in one of two ways. First, using debt crowdfunding, which is also called peer-to-peer lending, where investors lend money to an organisation which will then have to be paid back at a specified later date, plus interest. The second way is called equity crowdfunding, where an investor gives money to an organisation in return for shares in a business. One of the big advantages of crowdfunding is that innovative projects that traditional sources such as banks have turned down because they are too risky may be able to get crowdfunding, as given each person is only investing a small amount of money, the risk is much lower because if the project fails, each investor only loses a small amount. However, As crowdfunding is still a relatively new form of external finance, it is unlikely that an organisation will be able to raise lots of money this way. Okay, let's now move on to another source of finance that is willing to invest in riskier projects by asking, what is venture capital? This external source of finance is very much targeted at organisations that have huge growth potential but are considered risky. In such circumstances, traditional sources, such as banks, may not be willing to help. However, venture capitalist firms who are looking for better returns on their money may be able to. How it works is a business will approach a venture capital firm with a proposal for investment. If the firm is interested, they will invest money, say £1 million, in return for an ownership share in the business. Over the next 3 to 5 years, the venture capital firm will expect the business to achieve its growth potential so that it can then sell its ownership share in the business for, say, £5 million in order that it can make a substantial profit. The big benefit of venture capital is that risky projects that have been turned down by traditional sources will not only still gain finance to move forwards, but also venture capital firms provide expert advice to help a business achieve its growth potential and its objectives. Further still, even if the project fails or the growth potential is not realised, the business does not lose anything, as the venture capital firm's ownership share does not have to be repaid. However, a big issue with venture capital is that the business may have to give up a big ownership share in return for the investment they receive, which then means the venture capital firm will be able to influence the direction of the business, which may upset the original owners. Thus far, we have explored sources of finance that any private sector business could use. However, in some cases, certain sources of finance can only be used by specific types of organisation, which we will look at now by asking, what is a private share issue? This external source of finance involves a private limited company selling its shares privately to investors in return for money. Once the shares have been purchased, the investors become known as shareholders and part owners of the company. An advantage of issuing shares is that as they do not need to be repaid, they are a cheap source of finance. However, as the shares are sold privately, it can make it difficult to find investors, meaning not a huge amount of money may be raised. Having said that, in some circumstances, investors called venture capitalists are willing to invest large sums if they believe the business has huge growth potential. However, this may be at the expense of the new investor gaining a substantial ownership share. Further still, although private shares do not need to be repaid, the new shareholders will expect to be paid a share of the company's profits as a reward for their investment, which is called a dividend. Okay, let's now look at an alternative way shares are issued by asking, what is a public share issue? Unlike a private limited company that has to find investors to purchase their shares, a public limited company can raise external finance by selling their shares on a public stock exchange, where billions of shares are bought and sold every single day. Put simply, a public stock exchange is like a giant supermarket where those that want to sell shares can meet investors that want to buy them and become shareholders. As with a private share issue, one of the big advantages of issuing public shares is that they do not need to be repaid, meaning they are a cheap source of finance. Better yet, because a public stock exchange brings together so many people that want to buy and sell shares, it means a business can raise a huge amount of money from investors. However, as before, If a business sells a large number of shares, it also gives away a large proportion of ownership, which means the new shareholders will have some influence over how the business develops in the future. Moreover, even though public shares do not need to be repaid, that does not mean there is no expense associated with them. For example, when issuing public shares, a number of legal regulations need to be followed which cost money, such as preparing a prospectus and advertising the shares. Further still, those that invest in the shares will expect to be paid a share of the company's profits as a reward for investing, which is called a dividend. Okay, so that leads us to our last source of finance, and one which only companies can use, which is a debenture. A debenture is a way in which a company can raise a lot of external finance by borrowing money from private investors without giving away ownership rights, which of course shares do. How they work is that a company will issue debentures at a certain price over a given period of time at a fixed interest rate. For example, a debenture could be issued at a price of £10,000 over a 10-year period with an interest rate of 8%. Private investors can then purchase these debentures for £10,000 and in return will receive an annual return of 8%, which in this case would be £800. And at the end of the 10-year debenture period, will also get their original £10,000 investment back as well. One of the advantages of this is that as debentures are at a fixed interest rate, it makes it easy for a company to budget for the repayments. But more than that, as annual repayments are interest only, it means they would be lower than a normal loan. However, given the debenture must be repaid in full at the end, it puts pressure on a company to make sure it sets aside enough money to do this. And finally, like a bank loan, a company has to provide security for its debentures, so that should they fail to repay them, those that purchase the debentures are protected as they can take possession of the security. As has been demonstrated, there are a vast range of finance sources an organisation can access. It is therefore vital that when deciding which one to use, that a business does not just weigh up the advantages and disadvantages of each source, but also takes into account a number of other factors, which we will look at now by asking, what factors influence the source of finance an organisation uses? Probably the most important factor a business will take into account when choosing a source of finance is how much it will cost to use. Finance costs, such as the rate of interest or arrangement fees charged, all add to the cost of borrowing money and can decrease a business's profits. This means that an organisation may look to internal sources that do not charge any interest, such as retained profits, or external sources such as a government grant. However, as we found out earlier, such sources of finance also face issues in that they may not provide enough money to finance a project or the purchase of an asset. Of course, this raises a second factor an organisation will have to consider, and that is how much finance is required. If they require a lot of money, a business may have to look to other sources that can provide large amounts, such as a bank loan or a debenture. Even so, should a business go down this road, it will also have to consider whether to use short-term or long-term finance. In other words, the source of finance's payback period. In so much that a short payback period means that an organisation will have to pay large monthly repayments, whereas a long payback period will mean smaller monthly repayments. Now, although it may make sense to choose a longer payback period as the monthly repayments are smaller and more affordable, you have to remember that by borrowing for a longer period of time, that more interest will be charged, which increases the cost of borrowing. What this shows, and this is a key point, is that factors that influence the choice of finance used do not operate in isolation, but are connected and influence each other. For example, if an organisation has security to offer, such as property, it may be able to borrow money using a commercial mortgage over the long term, but also at a low interest rate, because the security makes the loan lower risk. However, if the project is high risk and the business has no security to offer, it may have to look to a venture capitalist to provide the finance required, which of course would come at a higher cost. Okay, so what did we learn in this presentation? Well, first of all, we found out about different sources of finance suitable for large organisations. We then went on to look at the advantages and disadvantages of each source of finance. And finally, we explored the factors that influence the source of finance an organisation will use. Finance is incredibly important, not only to the day-to-day operations of an organisation, but also to its long-term existence and success. This is why when an organisation is deciding on which source or sources of finance to use, it must make its choice carefully. Make the correct choice, and a business can pursue its strategy with vigour and energy. However, make the wrong one and the business will stutter to a halt. The source of finance chosen providing either not enough or overly expensive borrowing.